Flour exports are a key foreign exchange earner in Kenya and a critical part of the agriculture sector. Cut flours alone generated $765 million in 2012, up 10% annually, according to the most recent Kenyan economic survey. And the market is blooming.
Well, I think Kenya has a fantastic opportunity to grow, and the market's been growing for the last 10 years, and it seems like it's still on a good trajectory. There's been a lot of interest, and it's become a very global business, so it's become more interesting for us, and the opportunities are fantastic. We have a great climate, we have great water, we have great people, and from what I hear, we have a good product.
Drawing in from information that demand for flours is projected to grow 5% year on year for the next now 4 years. Much more because of the fact that we now hear Kenya has found water in northeastern, and all you need is the sun and water to be able to grow flowers. So we expect a very positive outlook for the flour industry from Kenya. And as you can see from this show, we have become a focal point, not just for East Africa, not just for Africa, but a global hub for the flour industry.
Meetings such as the International Flour Trade Exhibition are aiming to spearhead opportunities by placing dealers and downstream industries in one room.
We've come to exhibit Ethiopian flours, meet buyers, make contacts with people working in Kenya. Yeah, just to form linkage and to put Ethiopian flours onto the map with the buyers. Yeah, because obviously Ethiopia is expanding in flours, and we need contact with the buyers. This is a very good meeting point.
For us, the important thing about this event is an opportunity to meet our suppliers, it's an opportunity to meet our importers, it's an opportunity to meet new customers, and it's an opportunity for us to really see what else is coming into the market, and hopefully to create a potential for future growth.
Opportunities are plentiful, but the operating environment is proving to be a hindrance to traders such as Farah and Glenn. Kenya, Uganda and Rwanda are lagging behind, putting together an economic partnership agreement with the EU that is aimed at easing their access to international markets.
The economic partnership agreements are having an impact on the industry in terms of creating anxiety, and growers are very keen to see whether we'll be able to continue duty-free, quota-free access into the European Union, because that's what the agreement means. And so, if they are assured of which way the agreement is going, then they're able to plan long-term.
To be frank, it is worrying, and we're hearing good things on the ground that hopefully the deal will be signed. But these type of deals are very important, and ideally to allow the industry to flourish, they should be done earlier. And that would be our wish, that they do get signed off and we're able to keep on growing. Because the truth is, people talk about fair trade. And in order for trade to be fair, borders have to be open.
Taxes and subsidies are amongst the biggest holdbacks to the deal.
Some of these issues are around export taxes. The European Union wants to be able to access our raw materials, and we want to be able to put taxes on these raw materials as and when we want to encourage value addition to these raw materials. Other key issues are the export and domestic subsidies in Europe, which we are saying also have an impact of unfair competition for our products. And also the fact that you're looking at the most favored nation, whereby the European Union would like us, if we get into a better deal with another key economic bloc, they would like to have the same. So these are not deal breakers. And we are very confident that when they finally sit down, we believe very soon they will be able to resolve these issues.
Ethiopia is ahead of her East African counterparts, having already signed their partnership agreement.
It's important for the investors to know that there is an agreement, because all the while there is no agreement, that there is some uncertainty which obviously affects the investors. So people who have invested in Ethiopia are obviously very relieved that it's reached satisfactory conclusion with Ethiopia, and they can get on with doing their business.
The country's flour industry is receiving increased support from the government, making it a preferred destination for Kenyan firms eyeing growth.
I think Ethiopia offers a number of opportunities for investors. The government is very supportive of the expansion of the sector, so there is availability of land, there are favourable conditions for tax. You get 5 years tax holiday as an investor. You get a 30-70% arrangement for loans. A lot of the land already comes with water already provided. So there are many reasons to come to Ethiopia, and for some crops the growing conditions are very compatible with conditions in Kenya, and we have a number of farms now that have operations in both countries, and that's very healthy.
Kenya, on the other hand, has to also address devolution of resources owing to signing of a new constitution which requires counties to structure their own taxation policies.
One of the biggest challenges has been devolution. Although the long term will be fantastic, the short term has been quite painful. There's been a lot of additional costs, there's been a lot of additional red tape, there's been a lot of additional uncertainty about who does what and when and who's responsible. And I think one of the key challenges has been trying to work through that and understand what's the government's policy and what's their take. And I think they've struggled as well in the short run to map that road clearly for the business investors, but we're hoping that in the next 12 to 24 months, as devolution settles down, it will be more positive.
In actual fact, if you look at the cost of production in this industry, over the last 4 or 5 years, it has gone up by about 50%. The returns have only risen by about 7%. So there's a huge deficit which we need to close. Now, what the industry is doing about this is, first of all, we are working with government at both levels, the county government and the national government, to see that, first of all, no new levies and taxes are introduced. To also see that where we have duplication and multiplication, we can coalesce those, we can collapse those. And where we can actually expunge, we expunge those, so that we work on a tax regime that is business friendly. So we are spending a lot of energy on that.
How then do we exchange?
As the deadline for signing the Economic Partnership Agreement between the East African Community and the EU closes in on 1st October this year, streamlining of processes and systems within the region will be critical for these countries to tap into the opportunities the agreement will provide.